If you're in the early stages of running a business, whether you just started or you're trying to figure out if what you set up is actually the right structure, this mini course is going to save you from making the most expensive mistakes I see in stage 1, the startup phase. I've pulled together the best content from our deep dive webinars series into one place, specifically built for where you are right now. In this video, we're going to cover the following. First, the 3 stages of business growth, so you understand exactly where you sit right now and what that means for the decisions ahead of you. Then, business structures. This is the decision most stage 1 owners get wrong, and it's the hardest one to undo. I walk you through the framework I use with clients to answer exactly that. Next, financial literacy. That's your P&L, your cash flow, your taxes, and the simple habits that keep you out of trouble. Then finally, we'll end with some brutally honest advice that I wish more experienced business owners had told me earlier on my business journey. This will help you understand the upcoming challenges in stage 2 and stage 3 so that you're more prepared to deal with them later. This is a few hours of the most practical stage 1 content compiled and structured. And before we start, just a quick disclaimer. This video is intended for educational purposes only and should not be taken for financial, legal, or tax advice. Please consult a qualified professional about your personal situation. Also, some of the information in this video regarding discretionary trusts and bucket companies were accurate at the time of recording, but are constantly changing since the 2026 federal budget was announced. Please speak with your accountant for the most up-to-date advice, which would depend on how those proposed changes unfold. Grab something to write with. Let's dive right in. The 3 stages of growth regarding structuring. First one, I usually call it the startup phase. And then the second growth stage is actually scale up. And then the third stage, a de-risk and protection stage. So that's the stages of growth that I prefer clients thinking about. Okay, so let's start with startup. Usually when you're starting up a business and for growth purposes, you want something simple, you want something easy to manage, as well as it's cheap, because it has to be cost effective. You can't be, for example, when you're learning how to drive, buy a Lamborghini, because it's going to be very costly. Insurance is going to be very expensive, and if you damage the car, then you're probably going to be left in a lot of debt for a very long time. So that's why you don't go buying a Lamborghini when you firstly start driving or learning how to drive. Same thing applies to business. When you first start a business, get something cheap, get something that's manageable, not complex, so it's simple, as well as it's easy to run as well. Because the more complex it is, the more confusing it is, it then becomes a chore for you to try to figure things out when it comes to taxes, accounting, bookkeeping, as well as compliance. And then you spend less time running your business and learning how to make money and more time doing admin work. So that's why I always say first stage is startup, and always try to keep it simple as possible. And simple meaning either set up as a sole trader or set up as a company. And I think I have a good structure here, which it kind of explains that pretty well. The first structure or first startup phase for the stages is option 1 or option 2. And sometimes people don't do option 1, which is sole trader. They move straight to a trading company. And the reason why is because they need shareholders, they have business partners, and they also earn income in their personal name. So stage 1 could be like setting up a trading company. Okay, so when your business starts growing then, and you start making more money and you're scaling up, that's when you jump onto stage 2, which is scale up. Your goal for your business is to grow as fast as possible. You're starting to make money, your clients are coming on board, you start building a reputation for your business, and as a result, there is more money and more profit. And you feel like there's an opportunity for you to grow even more. So as a result, the goal for us is to minimize the taxes as much as possible so you can reinvest the money for growth even more. So that's why I call stage 2 the scale up process. And scale up usually means that you start setting up a hybrid structure. You may not have a bucket company, you may not have a SMSF, but you may then have a trust that holds your company, and it gives you the flexibility to minimize your tax by distributing profits to further individuals in the family, or even enjoying like a good tax rate of 25% in your company, and then a good tax rate in your personal name at maybe possibly 30%. So we start looking at where's the best possible way to keep the profits to minimize your tax within your family group. And that's where option 4 comes in. All right. So that's stage 2. So that's just a quick summary of stage 1 and 2. And stage 3 is de-risking and protection. So going back to here, let me get rid of my adjustments. That's when you start looking at SMSFs, bucket companies. When you start running your business and you start making a lot of profit and you want to start taking the profit, the next goal for you is, how do I protect the money that I've made? How do I protect the wealth? How do I protect those assets? And that's why stage 3 is to de-risk and protect your business. That's where you start separating your businesses and pulling it apart and putting the risky assets or risky activities in separate buckets rather than keeping it all in one bucket. Maybe not even activity. It could be just some assets that you know that you want to keep for long term. So you start looking at an SMSF, a super fund, you start looking at a bucket company, so where you can keep some of the cash and the profits. And then you might jump on more riskier ventures or, play with the money that you have right now. So that's why in stage 3, it's all about de-risking and making sure that you protect your assets and protect the wealth. And the funny thing with accounting is that a lot of accountants kind of generally just give you advice on how you set up, which is option 1, 2, and 3. And then they just stop there. And that's the part where a lot of businesses tend to not get the right advice. And then as a result, they don't learn like the 3 stages of growth, where they should think about startup, scale up, and then start de-risking and protecting. Some accountants go straight to stage 3, and then they talk about all these structures. And it's amazing, right? Like you can have a meeting with an accountant. The accountant starts talking to the clients about bucket companies, holding trusts, trading companies, SMSF. But if you don't even generate enough profits, then you're just spending a lot of money in terms of compliance costs. Because trading company could cost you about $3,000 to $4,000 in costs, and then the bucket company could cost you about $2,500, and then SMSF could cost you about $3,000, and then the trust itself can cost you $1,500, and then your personal tax returns $300, right? So if I add all that up, that's about $10,000 a year that you're spending. And that starts getting really expensive, especially when you're not generating the profit that you want. That could be like 10% of your actual profits. Oh, sorry, not even profits. It could be profits. 10% of your profits. Even worse, it could be 10% of your income. So that's why there should be stages for growth. And you shouldn't always consider moving straight to option 4, which is more de-risking and protecting your assets, because maybe there is no assets to protect in the first place. Obviously, jumping into option 4 is the easiest and smartest thing to do if you've got the money and you've got the assets already. It's easier, so you don't have to think about structuring later on down the track. But not everyone has the opportunity to have the money to spend 10 grand a year on their structure, as well as they don't have the luxury of understanding how this all works as well. Because if you there's a lot of clients that come on board with us from previous accountants that they say, I've got a bucket company, I've got an SMSF, and I've got a trust. Since I've set it up, I haven't actually used it or heard of the company or the super fund for the last 2 years. And that's where it's like kind of like a waste of having all those extra costs and those entities set up. That's the 3 stages of structuring for growth. All right, but let's start with stage 1 again. As I mentioned to you guys, stage 1 is to start off as simple as possible, as cheap as possible if you want, and keep it easy to run. It's really important to look at the different structures and understand the different structures, because depending on what you're planning to do, You may decide to buy things or set up a business in your personal name, which is a sole trader, or possibly set up a PTY limited company, which is you must have heard many times before, or something more special such as a trust or a investment trust. Yeah. All right. So option one and option two and option three are usually the main structures that people look at. Okay. It depends on what you're planning to do and the reasons why that structure might change. So the details that you need to consider when you're setting up a entity or setting up a business is you need to look at the tax rates, the simplicity, or like how simple do you want it to run, the income level or profit that you're making, the assets that you have personally, and the business or the investment that you have. Do you want to look at it as a short-term thing where it's like a 1, 2 years, 3 years investment or business, or are you looking at it as a long-term thing where it's 10 years, 20 years in advance? Because, for example, if it's like 20, 30 years in advance where you're not going to plan to change it, it might not be option one and two or three. It might be like a super fund SMSF instead. Because if you're looking at things like 20, 30 years in advance, then most likely it's actually for your retirement. So might not be even a sole trader, trading company, or a trust that would work for your structure. Also, when you're setting up this business or investment, you also want to look at succession planning. So succession planning is a fancy word, but it's all about what happens after you pass away, or you stop running the business or you retire. How do I pass over the business or the assets over to my offsprings or to the next person that takes over? And that's also where exit strategy is important. If it's not someone that's within the family, we also need to structure and consider exiting as well. So when I first started my business, I always thought about, okay, the exit strategy. The reason being is because if you go and run the business in one way and you don't give the option for exiting, it could cost you a lot of money at the end of the life of the business, like when you're planning to sell, because it affects the taxes as well. Property investment is also something like if you're buying a property, then you need to reconsider if you should buy it in your personal name, trading company, and investment trust. Also, one thing you need to look at is selling the business. They call it exit strategy and small business CGT concessions. I have done a deep dive on this, but it's basically can you make yourself eligible for those concessions, the really good tax incentives that ATO gives you when you sell your business. And setting up the structure right from the start can give you that opportunity to be able to get those benefits. So that's why I always ask that question. Is it useful for you? Is it useful to consider exiting in the next 5 years? If so, then we should structure it properly to make sure that you can meet those eligibility requirements. Last thing is also when you're planning to retire and when you're planning to, are you planning to pay money to super? Depending on what structure you have, some structures force you to pay super. Some structures don't force you. Like sole trader, for example, you don't need to pay super. A trading trust, you also don't want to pay super. I don't know why. Oh no, I do know why. But some team members and some clients don't like super. Maybe it's because the client or the team member is young and they don't really understand super, but they also possibly don't think that they can access the money until 40 years later. So they don't really want to worry about super. And that actually does affect how you set up the entity as well. Cool. All right. So that's overall the different things you need to consider. But in terms of like what the difference between a sole trader, a trading company, and a trust is, a sole trader is basically a individual that owns or runs the business or owns or runs the investment asset. And legally and tax-wise, that sole trader is liable for everything. So they own the business, but they also own the asset, but they also liable for the business's liabilities as well as the debt, the taxes, and the risk, and also it owns all the personal assets together. So a lot of people talk about issues where there's no asset protection for a sole trader. And so a sole trader doesn't have asset protection is because every asset that they own personally, like it could be a Ferrari or a car, it could be boats, they are owned in their personal name, and also the business assets are owned in their personal name. So if something happens to the business, they can basically, the person that's suing them can go after all the personal assets, not just the business assets. That's why a sole trader could be a bit dangerous. A company, on the other hand, it's a separate legal entity. Basically, instead of having an individual, we create a robot. We create a robot, and we've now given the robot some statuses. That robot would now have a flat tax rate of 25%. So 25%, sometimes 30, depending if it's investment. So if it's for passive income and investment, it's usually about 30% tax rate. But in this case, for a trading company, we kind of consider a robot, we give it a flat tax rate of 25 to 30%. We also say that it's got its own separate ownership of assets. So it can own assets for the business. And we usually put the business assets in this trading company. As a result of owning those assets, it can be sued, and it can sue as well. So it can sue others. It could also be sued by, the creditors or, employees or suppliers. So as a result, your assets are protected kind of thing, because your personal assets sit in your personal name, and then you've got your business assets in the trading company. So that's where they say there's a limited a level of asset protection by having your assets personally protected away from the trading company. And also the risk falls on this entity rather than your personal name. Yeah. So a trust is kind of complex, but the way it works and the way I explain it is, back in the day, this is how I learned it back in uni, is that there used to be the kings and queens back in England that would go, especially the kings, that would go on crusades. And when they went on crusades, they would leave all their land and their assets to be managed by someone. And that someone ended up being something called a trustee. So they created these used to be people, they're individuals, and they controlled all the assets that was owned by the kings and queens. And so what they did is they created something called a trust. And over time, the trust then developed into like a tax structure. So now people create trusts just to own assets, but on behalf of the individuals, and they call those individuals beneficiaries. But they made it even more complicated. Beneficiaries doesn't have to be individuals, doesn't have to be just mom and dad. It could be, children. It could be charities. It could be related companies as well. So that's where that's what's happened with the trust, where the beneficiaries now are these individuals, but anyone also related, or any entity related to this individual, the main primary beneficiary. Then what they did is they split the control. The control now is not managed by the individual or the beneficiary, it's managed by the trustee. And they also said the trustee could be an individual, but it also could be a company as well. So that's where they created the term trustee companies. So trustee companies are basically a separate entity that the whole job of that trustee company is to control the trust and own the assets in the name on behalf of the trust. And obviously the trust just has assets and profits, and the profits then get passed over to the individuals or the beneficiaries every single year. And that's what a family trust or investment trust is, discretionary trust. And that's how trusts were created. Obviously, there's different types of trusts. We won't go into particular details of that. But basically, a trust is a relationship with a trustee who controls the assets of the trust on behalf of the beneficiaries. And the beneficiaries are determined in something called a trust deed, which is a fancy word. All it is an agreement when the trust was set up that basically has a rule book of the trust and what happens to the trustee, how do you kick him out, who is the trustee, who are the beneficiaries, how do we pass profits out, all that stuff like that. So anyone have any questions so far?
Does holding the assets in the trust protect the beneficiaries of the trust if the company was sued?
Yes. Okay, perfect. All right. So yes, but only if the trustee is a separate legal entity, they call it. So it's not an individual. But the trust could also be, let's just call it Davie Mach. Could it be Davie? And the individual who are the benefits could also be Davie Mach. So if I own this business, then I'm technically, if there's assets in this trust, the trust itself can't actually be the person that owns will be the entity that owns the asset. In the legal terms, the trustee owns it on behalf of the trust. So if I put my name as the trustee and then I go and buy a property for the trust and I stand in contract and it says Davie Mach as the trustee, but also the owner of the assets, then if someone goes and tries to sue me personally for something, maybe I was at the pub, got into a fight, injured some person. So now that some person is suing me for, hospital cover and health cover and injuries and damages and all that stuff like that. It goes after me for $1 million. They can then go do a search on ASIC to check what assets I have. And I unfortunately own the assets on behalf of the trust. So my assets for the trust will also show up and then they will go after those assets as well. So the answer is yes and no. Only yes if the company is a trustee, because if the company is the trustee is a company, sorry, then that means that the company will own the assets and your personal assets are separated. Yeah. So that's why they say some accountants for some weird reason say, or set up a trust instead, because it's very beneficial for asset protection. But I think the company also has that level of asset protection as well. Yeah, because it's basically borrowing the benefits of a company by having a trust. So a trust in a trading company has the same benefits in terms of asset protection. Yeah, but the trust has something that's better than a trading company that a lot of people forget, which is if you had two owners of the company, which is individual 1 and individual 2, and they both own 50%, the company has a fixed ownership between these two owners. When you pay profits out, they have to go 50-50 to that person, to these two people. You can't give them one person 80, you can't give the other person 20, because the fact is this person owns 50-50, these two. Whereas a trust doesn't have that type of structure. It's like every year the trustee determines who we should give the profits to. So it gives you flexibility to be able to distribute the profits. So when a accountant tells you, oh, you should set up a trust because there's better asset protection, I actually think that's false. I think the benefit of a trust is the flexibility of being able to distribute your profits and give it to any beneficiary depending on the year or depending on what the trustee decides. The trading company has that issue where they can't do that. Yeah. But there are other ways to pay profits out. You can pay a wage or a contractor fee, but it's not really that well done. I think one of my clients mentioned that, the ATO might pick that up and say that you're creating a tax scheme if you're paying this person a contractor fee just for tax purposes to minimize tax. Yeah, so it's better to have a trust involved. That's why there's option 4 where you have a holding trust. You have best of both worlds where you set up a hybrid structure. I call it a hybrid structure, but basically it's like a combination of a company and a holding trust, and you get best of both worlds. Okay, why would you not do that? It's because it's expensive. There's no point setting up a company when you first start a business with a holding trust, with a trustee company, an individual, because it's quite expensive to set up. This structure here might cost you, about about $6,000 to set up. Whereas this company here costs you about $1,000 and this trust costs you $2,000. So why pay 3 times the amount, or even sometimes 6 times the amount just for a better structure when you're just starting off and you don't even know if the business is worth anything and you're not even really investing that much. You might be just investing $5,000 into business, and then you go and set up a business entity and structures for $6,000, which doubles the amount of cost that you're investing. Yeah. So my goal for businesses is for them to determine what their reasoning of starting this business or starting this investment structure, and then we will give you the best outcome or best structure for you based on what to consider. So if a client came to me and they said, Davie, I'm wanting to open up a gym. I've got my income, I think with the gym will be about 200K. So 100K as a salary, and then probably about 100K in profits. And my property, my assets, is just like a house. That's my home. Okay. And nothing plans yet. I'm just starting off my first business. No property, no other investments, No, maybe one day I might sell my business. But right now the goal is to build that gym and maybe open up multiple gyms. And that's usually the main goal for most businesses. They just want to grow the business as much as possible and then possibly one day possibly sell it or just reinvest the money. So reinvest money into property. Okay. Generally, that's most people what they want to do. So this is a gym business owner. So in this case here, if it was a gym business owner and there's a sole trader, he could always open up the business as a sole trader. It's very simple. The cost is only like about anywhere between $300 to $1,200. Could be more, could be less. Just depends on how much work they want to do. And then also it's simple, right? You don't need to lodge multiple tax returns. You just need to lodge one tax return in your personal name. However, there is cons, and the cons are basically if you get sued, they go after the owner, and the owner is you. And so therefore your assets plus personal assets are tied into it. Personal assets are at risk. So these things here make it that it's a bit more risky. Okay, if the business wasn't a gym and the business was just PT, there may not be that much risk except for the house. However, because it's a gym, there is a lot of investment that goes into a gym. Most likely he will be spending anywhere between $200K to $500K in cash injection. He would also be signing a lease that would have a lease of at least 100K plus for say 5 years. So that means about $500,000 that he could be up for the next 5 years. By doing that, he may prefer having a company because he's separating his personal assets, so assets in his personal name, and maybe if he has a partner or if he has a business partner, they may have their own personal assets, which is a home, and they might have the company that signs a lease that also has the trading and also manages the business through that company instead. So that's why it may be better not to move as a sole trader or set up as a sole trader, but set up as a company in the first place. Yeah. So, and the cost for a company isn't that expensive. It would probably cost you $1,100 to set up. And then it will probably cost you anywhere between $3,000 to $4,000 in fees to manage the admin side and the accounting side per year. So trading company might be the next option. Some clients prefer a trust instead because they've got a lot of family members, they're low income earners, and they like the benefit of using a trust where they can distribute profits. They like the anonymous, that it's not under a company and the directors is actually under a trust. It's harder to find, harder to know who the owners of the business is. So sometimes a trust is also an option as well. I tend to not like trust as a trading entity. And the reasoning behind it is that trust doesn't pay tax. Trust doesn't pay tax, right? So that means that the trust needs to distribute the profits to the beneficiaries. And the beneficiaries are usually the individuals. And so if you're making about 100K in salaries and another 100K in profits, you could be at the highest tax bracket of 47%. And if you've watched my videos, you understand how that works with the tax rates. But over 190K, you're at the highest tax bracket. So every dollar that you're making over 190K gets taxed at 47%. And the trust doesn't allow you to pay taxes. It makes you distribute the profits to. And the only problem is you only got these individuals to distribute the profits to. Then that's where you pay a lot more tax. A lot of people then talk about, or maybe I can set up a bucket company later on with the trust where you can distribute the profits to a bucket company. But then my argument is, why don't you just keep it simple and have the trading company hold the business, and then you can have a 25% tax rate, which is better than the sole trader at 47% if you're high income earner, or individuals 47%, and it's cheaper because you don't need to have that trust there, especially when you first start off. That's basically stage one. Thinking about these things to consider: assets that you have personally, the investments that you want to invest into the business, the cash that you're spending on, also the risk of running a business. Like I said before, if you're a PT trainer, like the transactions or the activity you do with your clients, if you were to get sued by the client, how much would they sue you by? Not as much because the transaction you're charging them is probably maybe $100 a week or, $200 a week. Whereas if you're a gym, it's not just your clients that could sue you. It could be your suppliers. If someone gets hurt at the gym when you're not around, when it's 24/7, they could sue you not just for the fees, but they could sue you for damages and injury. And with a PT, less likely for you to be sued because you're just advising the client. Obviously, you're watching them and you're trying to protect them, but you also got your insurance to cover you for your professional indemnity. So that's why a lot of PT trainers are sole traders, because cost is cheap, it's simple, and there's not much for them to risk in terms of assets and for them to be sued for. So and their activities are quite low. They're only making about anywhere between $50,000 to $100,000. So if they were to get sued, what can they really sue for damages for? But whereas a gym, someone can hurt themselves at the gym. A supplier could be dropping off supplies and they hurt themselves, or something happens to the shop, or there's a whole bunch of things, and or the landlord can sue you as well because you don't you damage the building itself, or you just can't afford to pay for the lease. So therefore they'll go after you 5 times the annual lease. So therefore then that could be like $500K. So that's a lot of money. So that's why it's a good idea possibly to separate the legal entity and have it as a trading company. Whether you sign a personal guarantee, you have to speak to a lawyer. Some landlords they require you to sign a personal guarantee as well. But the main thing that you want to protect, even though you sign a personal guarantee, is all the other activities that you may do when you run a business that they can go after you for. So that's why it's always a good idea to look at option 1 and 2. Option 3, like I said before, it is a possibility. It's only special cases that I think it's a really good idea to run a business through a trading trust. I usually don't like trading trusts. I usually prefer it as a company over there. Financial literacy matters because you, as a business owner, make decisions. And these decisions every day could be about investing in a property, could be about employing an employee, and it could be about taking on a client and thinking that you can afford to pay for the expenses for the client and then wait for the money to come in. Those heavy and hard decisions that you make would affect your business and could actually bring the downfall of your business. For example, if you go and buy an investment property and you take the money out of the company and you invest it, then you've forgotten to pay the taxes because you haven't looked at your numbers. Another example is you might employ an employee thinking that you can afford it, not realizing that superannuation, payroll tax, wages tax, and insurances that then push your business up to a certain point where it's negative cash flow. And it usually takes a bit of time for your employee to get onboarded and get ready to start making you money. So they are the things that you need to understand when you read your numbers. And lastly, obviously, when you're making a decision, taking on a client, and this is actually very crucial for a lot of builders, is that when you do a build, you need to know your numbers because the build itself could be $1 million and $2 million. And you don't have $1 million in your bank account to fork up to pay for the materials, the subbies, to do the work. So you need to make sure that your installments that you're charging your customer can be used to be and put you in the cash flow positive to be able to do the project. And that's why like a lot of builders go under. It's not because with some of it obviously is like rising material costs and all that stuff like that, and like red tape, but a lot of it is to do with they just not managing their cash flow well, not charging the right amount. Yeah, and then as a result, they're actually not making money by the end of the day. And that's what causes a problem. And I see it so many times. And that happens to many businesses, not just construction. Cool. All right. So let me know if you have any questions, but I'm going to start off with sharing my screen. Okay. So this is a profit and loss that I didn't upload into ChatGPT. I just asked ChatGPT to produce me a P&L for a recruitment company that's been in business for like about 2 to 3 years. And it's produced me a profit and loss. So this company here, this is the financial statements. So there's a profit and loss, and there's also something called a balance sheet. So profit and loss is what its name is. It's basically shows you the profit or the loss that you've made during the year. And usually during the year, it's 1st of July to the 30th of June. And that's because the financial year that we're in. It's basically the statement that shows how much money you've made at the end of the day, or how much money you've actually made, have made a loss of. So how much losses you've made throughout the year. The main thing you need to understand is there are like basically 4 components of it. It's revenue, which is sales and income, and then cost of sales. So cost of sales is basically any expense that's directly related to you making that $1 or making that dollar. So basically, because you got to understand the nature of your industry. So if you're a recruitment services and you're charging a fee to find a employee for one of your clients, what you need to do, what your expenses would be that directly relates to you making that $1 is background checks, for example, and job ad posts. So for every job that's available, you will probably spend, $50, maybe, no, sorry, not $50, like $500 of job ad posting. So these expenses are directly related to this. If you have 0 clients and you don't have any positions to recruit for, then most likely these will be $0 as well. So that's the difference between cost of sales, which is the expense directly related to your sale, versus like operating expenses. Okay, that's where you have to know the key difference. It's actually really important to know this, because sometimes you look at this and then you go, you start looking at the ratio. So you go, there's something called a gross profit margin. And this is very important for some of you guys that run e-commerce businesses, for example. So a gross profit margin is basically your gross profit, which is this amount here, which is revenue minus cost of sales divided by your total turnover. And so this is currently at 70%. So basically every dollar that you're bringing in, you're only spending about 27.5% to make that dollar. Okay, so every dollar that you're spending you're only spending 27 cents to make that dollar. And that there is a good business. If your gross profit margin is, say, 50%, that means that every dollar you're bringing in, you're spending 50% of that dollar, 50 cents, to actually make that dollar. And it's actually hard work. That means that you can't really spend a lot of money to operate your business. And it's I don't know who created this, but I realized that it's actually a good thing to actually understand. Because here, if you do the analysis when you first start your business and you see that this is usually, more than 50 to 60%, and there's no way for you to be able to drop this, then it's something that you need to consider before even starting the business. Obviously, when you first start the business, it does look not the best. So sometimes you may spend more money doing job ads and background checks. And the reason being is because you might suck at your job, or you're trying to figure out how to do better. And so you're spending a bit extra because these job ads are lasting longer. These background checks, you have to do a few times because you've done them wrong. And also the contractors that you're spending money on may not be the right ones, like right people to spend on. So you end up spending a bit more as a result. And this happens with e-commerce as well. You might have been buying, $420,000 selling $420,000. But when you sell $1 million worth of stock or sales, that means you get economies of scale. You get a bigger discount when it comes to your suppliers. So as a result, it's actually it's okay if your gross profit margin is smaller, but you have a plan for it to be higher over the long term because of economies of scales. And economies of scale is basically, it's a term meaning that the more you enlarge the activity that you're doing, so the more you scale, the lower the cost is, and as a result, the more profit that you make, or the more efficiency you produce in whatever you do. Cool. So that's revenue and that's cost of sales. And the whole point of this is to work out if you're making money at the end of the day. So obviously you need to add in the operating expenses. So operating expenses could be fixed costs, could be variable, doesn't have to be one figure every single year, but you will most likely have to pay for wages for, admin staff or the director. You also have to pay for rent. marketing software. And in this case, for a recruitment service business, these are the expenses they pay. Okay, like I said before, e-commerce businesses will have a lot more. You can determine how you want this to look because you're the one that puts this in Xero. Okay, so you could actually make this look a lot more bigger. Like you can have the profit and loss be like 2 pages. And how you change that is through something called a chart of account. So in Xero or the accounting software that you have, there's a section where you can actually go on to the chart of accounts. And basically, a chart of accounts is a fancy word, but really what it is just a classification of your types of income, the type of expenses, as well as even your assets, like the assets that you purchase in the business and the liabilities. And I'll go into more detail about assets and liabilities in when I talk about balance sheets. But this P&L, you can build onto it even more. Some people would prefer not just to look at recruitment service fees. They might want another account, and they can create another account and then call it recruitment service fees for international jobs. And then they want another one for international, for domestic, which is like Australia. So they might be like working overseas and they just want to track the sales they're making on international jobs and Australia. It could be for e-commerce, similar case. It's up to you. So for me, when I run my business, I actually have probably about 10 of these revenue items. And I go into detail of, annual businesses. So business services, tax advice, company setups. So I just track all of those. Commissions, if I have any commissions. And I just want to see which one, the reason why I want to track all of them is because I want to see which one actually makes me the most amount of money versus the amount of expenses I actually spent. Then I can determine later on down the track, which one should I focus on more. Okay, so for the mortgage brokers out there, you might have commercial asset finance as a line item, which is more for businesses, and then resi commissions or resi's income, which then you can track which one is actually doing better. If you see that commercial is small, but you spend less time and it actually makes you more money and you can see it trend as if it's growing every month, then that's where you go, all right, I need to focus on that. Because that's actually where the gold mine is. And I'm going to make a lot more money eventually on the long run. But you can't see it because you just see $600,000 as a whole if it's grouped together. So that's the importance of looking at the profit and loss and determining how you want to split this up. Don't just rely on your accountant because your accountant doesn't really care. Okay? What your accountant's job in the end is not just to tell you how to run your business. It's actually to tell you how much tax you're supposed to pay, how to get your financing. And that's like the external, but also the main goal for you overall. But how you make that extra dollar is most likely, an internal accountant's job or you as a client. Oh, got a question. Okay, so would costs of sales include internal costs that may be incurred, such as house, time spent on a proposal or tender response? Yeah, that's a good question. So basically, just to explain, that's and my differentiation of what you're talking about is like, you do consulting. And so as a result that you're spending a bit of time trying to tender for a job or prepare a proposal for a job. And you might do like preliminary work. The preliminary work and the tendering for a job is actually covered in salaries and wages for usually admin staff, right? Because if you were to outsource that, like eventually when your business grows into like your business could be up to this point right now, but say like you're at 10, 15 mil, you probably won't be focusing on preparing those documents and preparing for the tender. You'll have people doing that. And as a result, it's actually covered in like overhead costs, which is operating expenses. And that's like, salaries and wages. Because the more people it's more the actual cost that would directly relate to an extra dollar that you're making, for example. So in this case, recruitment, it's just job ads. If you post more job ads for jobs, you're going to get more candidates. And as a result, you're probably going to make more money. Yeah. Yeah. So you wouldn't be putting a job ad out if you didn't have any clients. Yeah. So the tender job, same. I guess you can argue the same thing. You wouldn't be doing a tender job for a tender or preliminary work without putting without any clients. But I guess in this case, it's kind of indirectly related, whereas this one is completely directly related. And I think the best example is like when it comes to e-commerce. If you buy a material or a supply, when you sell it, you're going to sell it for 3 times more. You buy one for like say $3, you'll sell it for like $10. And that there is cost of sales. That's how cost of sales is. If you're not sure about it, don't worry too much. An accountant can help you out with this. But your wages is usually covered most of the time as a director or owner of a business. It's usually covered in operating expenses. And that's where I put it. Unless you're an accountant and you're doing accounting work, and the director himself is only doing accounting work, he's not managing a business, then you put the accounting service expenses as cost of sales, which is what we do in our profit and loss. Okay, that makes sense? Hopefully I answered it, Andrew, but it's a bit confusing sometimes. Like, yeah, but what you're doing is actually admin work when you're tendering for a job, so therefore it should be in salaries and wages. But if you're actually doing principal work, they call it, where you're doing the work for the service you're providing, for example, which is accounting. If I'm an accountant and I'm doing tax returns, then really I should be in cost of sales. Yeah, my wages. Yeah, but my job has changed over time, so now it's more actually in overheads. Initially, it was in cost of sales as well. Cool. All right. Sounds great. So I think I was in operating expenses. So the whole point is looking at GP, they call it gross profit. And then after it, you look at all your operating expenses. Basically, most of these are usually sometimes fixed. So for example, rent is fixed. It means that's usually annually the same amount every single year, or monthly the same amount. Software can be fixed as well. Accounting and legal is fixed. Travel insurance is fixed, and other admin is probably most likely, like if you throw a stab at it, 5K a year, you're most likely going to spend that amount. However, these ones here are more variable. It just depends on, who you need. And if your business grows more, then you most likely will increase this. It's important to know the difference between variable cost and fixed cost. The reason being is because it helps you budget. So at the end of the year, or at the start of the financial year, before 2024 starts, I might just go, all right, let's produce a budget. And then I would then go, all right, well, I want to increase by, times this by 50%, for example. So therefore I want to go up to 900K. So how much, and then you start running the numbers, then going, okay, well, how many jobs do I need to do to be able to make this? And you can just work on variable, if you want to be just having a stab over it and just working out a solution of being able to figure out how much you should spend on things, you need data to be able to do that. So the more years that you're in business, the more information you get. And from all the information you're getting, as well as the research that you're doing online and speaking to colleagues, you start deciding, okay, well, what variables or what things do I need to take in mind for me to make that 900K? So for example, the last few years, I spent 150K, which is 25%, for contractor payments. So most likely, and I spent the same amount last year. So most likely, because of that data that I've got, I can now make a decision. Okay, maybe I'll budget 25% for this, for contractor payments. And same thing applies to these ones here. Okay, so you could do 2% for this. And then same thing applies. Okay, you're not going to get this right all the time. Okay, I just want to point that out. You're not always going to get this right the whole time. This formula doesn't always work, because what happened last year isn't the same as this year. These expenses might go up, and the growth, the original data that we had of 25% of contractor payments versus your total turnover may not apply anymore. But that's where you chop and change. If you look at these numbers on a regular basis and you see that your expenses are rising, then you know that maybe you won't be able to hit the 900K, or there are issues in your business, and you can deal with it on that point. And I'll go in more detail of that later. So, all right. So the same thing applies with these. But remember how I told you need to understand fixed and variable cost? So understanding fixed and variable cost, then you can actually determine what cost stays the same. So these ones here that I put in bold are the ones that most likely will stay the same. Okay, whether your business grows to 900K or not, because you got enough people to cover, like enough space to cover for the people that are joining you. You also got enough software, and legal and accounting should technically stay the same next year. Might put a small percentage of increase just to cover for it. Same goes with insurance. You might put a small increase for next year. So you do, what I would do, which is maybe just bump it up by, inflation, and do the same thing for here. So this here, what we're doing right now, if I can finish this, and then these are the variable costs. So you might go, all right, well, I am thinking for my decisions and for my planning, I've decided I'm going to hire an admin person or a junior accountant or junior recruiter. So therefore, my salaries and wages is going to go up. And salaries and wages here actually include super. So I just want to point out super is not showing up here, but it's because it's included in here. Cool. And then marketing expenses. You know what? I'm going to be tripling that. I'm going to times that by 3 because I need to grow this. So in order for this to happen, I need to make sure I spend more money on my marketing. So I had this plan. I met up with a marketing agency and I decided I'm going to spend a lot more money on marketing. And as a result, I'm budgeting extra $30,000 on budget on marketing. So travel and client meetings, I've decided because I'm going to meet more clients, that's going to also go up as well. So as a result, this is how much I'm going to be spending. Okay, now I've done this. I've worked out my revenue. What have I essentially done, guys? I have worked out my forecast. This here is a budget forecast. And then now I've got my net profit. So I'm going to just pull that in. Nope, that formula's not working because ChatGPT is not smart enough to do formulas yet. So let me just do that minus this. So now my profit should go up immensely. Okay, so now I'm making money. But this is the part where a lot of business owners don't do, and a lot of accountants don't also do for their clients. What they should do now is now split this into monthly. Look at this on a monthly basis. So what you can do, you can put this in ChatGPT, you can split it into monthly, or you can just create, 12 months and then average it out or put it in seasonality. And then the next thing you should do is go into Xero or your accounting software. So this is a demo company that I'm on Xero for. And if you go into the profit and loss, you can actually open up your P&L. And then I track this every single month. This is what I do with my team, my managers. So I go to accounting, profit and loss, go to current financial year by month, and I check this current financial year by month. Okay, obviously not all the data's there because it's a demo company, but I'll check this against my P&L here that I've created, which is a forecast or budget forecast. And I'll compare, am I actually on the road to getting there? So, in order to get to 900K per month, I need to be doing divided by 12. $75,000. Okay, I'm definitely not there yet. So therefore I need to adjust. Say I'm in April right now and pretend that these numbers are all there and I'm doing $10,000 and my net profits are in losses, right? What does that mean? That means that I should really make a decision. And that decision now is reduce my costs because I'm not going to get there. I'm not going to make that 900K. So all that money that I've been spending on to try to make enough money to, grow my business and end up getting this profit, it's not going to happen. And the only way I can figure that out is if I track my numbers, understand my numbers in my P&L, and do a budget forecast at the start of the financial year, and then compare as we go and make decisions. I might decide that the person I hired that was on 60 grand was not the right person for me, so I should get rid of him. Sorry to say that. I'm making it sound like it's that easy to get rid of a person, but it's, or maybe I'm not training that person right and I need to train them better, or they're in the wrong position, or I need someone that's more experienced. So as a result, things that helps you start making decisions Okay, so that's how you read your P&L, you prepare a budget forecast, and then you compare and monitor against how you're actually doing. So that requires you to actually know how to use Xero. It requires you to get up-to-date bookkeeping. And this is the missing step that a lot of business owners don't actually do, to be able to go, all right, I want to make $1 million this year. How am I going to do that? And then how am I actually going? It's just a habit you need to do on a monthly basis or quarterly. You don't actually need to do it monthly. You can do it every 3 months as well. I do this all the time and I track it. So every 3 months, I'm like, oh, I need to hire another accountant. And if I do hire another accountant, I put the numbers back into here. I just add, in simple terms, I just add another $100,000 if the employees are worth 100K and go, all right, well, if I put 100K in, I need to boost this up by a certain percentage. Okay, does these numbers make sense? And then I track it for the next few months to see if it's doing well. Balance sheet is also very important. So the most simple way to explain what a balance sheet is, it's actually a snapshot of your business at one point of time. So what it's worth, how much assets it has, like what does it own versus who does it owe? And then that's the total. That's what the balance sheet is. So a lot of people get confused. They go, oh, well, is this what the business is worth? If I go to if I go to the market and I sell it, do I get this money? Unfortunately, no, because in your balance sheet, because we're just preparing simple balance sheet, not showing it to the whole world and not preparing it like general purpose financials, they call it, or general purpose balance sheet, you don't actually need to put in some of the assets that are sitting in here that are market value. So this is actually generally everything that you have at cost. So what you've purchased, like you bought office equipment for $10,000. You've got money in the bank account about $90,000, and you've got trade receivables of $50,000. However, if your office equipment that you've purchased might be worth a lot more on the market. So if you bought it for 10K, but technically it might be worth $15,000. You might have got a discount. So that's not going to show. So therefore, this balance sheet is not a good view of actually what your business is worth on the market, but it's just basically what it's worth costs usually for small businesses. Okay, there's some things that are missing also, which is some things that you can't actually value unless you get a expert opinion. So, for example, if you're running a gym, you can't value your customer membership. So your membership base and the number of members that you have it's called basically goodwill. If you were to sell that business, they want that. They want your member base and the recurring revenue, and that's not going to sit on your balance sheet. So therefore, your total assets showing 184,000 isn't really a accurate number of actually what your business is worth. So that's one thing that you need to be aware of, that a balance sheet just shows really a basic version of your assets. It's missing a lot of data when it comes to actual market value, but it's quite important as well. So that's kind of like a balance sheet. And then it's also got its liabilities, which gets deducted off your assets. So your total liabilities could be like, trade payables, super, ATO fees, ATO liabilities, as well as maybe, money that you drawn out of the company or you need to pay to yourself, and most likely loans as well. So if you've got car loans, that's also a liability. Actually, I did a bit of a play with ChatGPT, and I asked ChatGPT to tell me what a balance sheet is in simple terms. And it basically said, balance sheet is like a house snapshot. Imagine your business is a house. The assets are everything that's valuable inside the house. And the liabilities is the mortgage or the credit card that you use to purchase assets within the house. And the equity is what's truly yours. So if you sold the house and its belongings and everything inside and then paid off your loan, the equity is what's left over. So that's how ChatGPT explained it. Total assets minus total liabilities minus equity should equal 0. That's the rule. Assets minus liabilities minus equity equals 0. That's how it works. Okay. One thing that you need to be clear of as well is the profit and loss and the balance sheet actually relate to each other. You'll see here there's current year profit. And that current year profit also is showing here as well in your P&L. Okay. And the reason why they relate to each other is when you make money, the business makes money and the money hits the bank account of the company. And it's also showed as equity, like a retained profits, they call it. So that's why the P&L and the balance sheet is very, they relate to each other and they're very important. You need to have both. And that's why the banks usually ask for it. Okay, so I actually spent a lot of time explaining both these. I haven't went into too much detail of the balance sheet, but I want to say that this is really important for you to know. Okay, you don't learn this in school, and the unfortunate thing is I don't even know why you don't learn this enough. Like people should learn this if you're running a business. They should do a course about it, and because the reason being is because when you want to do things in your business, you need this information. You need your balance sheet, your P&L, and you need to provide it to the bank. And no one tells you this when you first start up your business. And the reason why they need this, the banks, is because they look at this to determine if they can give you a loan. Yeah, so they look at all of this information, the balance sheet, the profit and loss, to be able to determine that they can give you a loan. Yes, they can look at your company tax return, but when you look at a company tax return, it's actually very basic and summarized. So they don't actually know what actually is in the P&L that actually determine because the profit and loss that you show in the tax return is actually different from the profit and loss that you show to the banks. Okay, why? Because you get all these different adjustments for taxes. You get accelerated depreciation. You get some expenses here that actually are not cash payments. Like you don't actually need to pay for those. And you haven't paid for it. So the banks add that back or add additional expenses back in and they reduce your payments. Yeah. So a big example is your loans. So these loans here, they don't show up in your P&L because they show up in your balance sheet. But then with the bank is that if they lend you based on this 100K or 300K profit or 195K profit, they need to understand that they still got now about 50 grand worth of liabilities that the business owner needs to pay. So they got to be careful. Can they afford to pay this amount as well as pay back that loan that gets borrowed? So that's why a balance sheet is quite important. I won't go into specifics of the balance sheet because I'm short on time. But yeah, the balance sheet is just a snapshot of all your assets that show up here and the liabilities you have. And the one things that you need to pay attention to as a business is this, your liabilities. They are the most important things. Obviously, looking at this is also nice. You can see it usually in your bank account. You'll see 90 grand and you're like, yeah, amazing. Okay. But the liabilities is really important. And as a small business, there was one more thing that's also important. This thing here, trade receivables. And I'll tell you guys why. Because there's something called cash is king, right? You guys have heard this term before. Cash flow is king, right? Cash flow is king. It's used everywhere. All these business gurus talk about cash flow is king, and it's actually really important. And cash is king mainly because trade receivables affects your P&L significantly. So this person here is on, let's just bring it back a bit and delete this and then delete all the adjustments I've made and show you what I mean by cash is king. You can actually show that to the banks or to everyone that you're making a profit, but your cash is not doing well. So for example, this business here made $195,000 in 2024, but and the business actually collected he's got $90,000 in the bank. But if that $90,000 is not it's not 90,000, it's actually $10,000. I'm going to adjust this a bit real quickly, and I'll show you why this matters so much. The banks actually look at this as well. So let's go back to this. So I've only made one change to this financial statement, and I actually think this business isn't as good anymore. Okay. So the change I did was that they didn't actually collect the full amount of the invoices. They're missing like $80,000 worth of invoices that hasn't been collected yet. So they've done the job. They've issued the invoice. They look like they're making money, which is here, $195,000. But they've got like trade receivables amount owing to them, $130K. So if I dive deeper into the trade receivables, and I look at the trade receivable report. Trade receivable is basically, in fancy words, in an easier way to know, is basically people that owe you money, your customers that owe you money. So I've sent 130K worth of invoices out, and if I look at the trade receivables report and it says that it's 60 days overdue, my customers aren't paying me. That's a big problem. Okay, the reason why that's a big problem is if you go back to here, is you've got current liabilities at $50,000, meaning that all your tax liabilities that you owe to the tax office, plus customers or contractors not customers, suppliers that you have to pay, you have about a total of $50,000 you need to pay, but you don't have it in your bank. That's where cash flow is king, because people think that just because this P&L looks amazing, you can't actually afford to actually pay this. And that's the problem. You're actually going to have problems in the next few months because you haven't collected that money. You're not going to actually be able to survive in the next few months to meet the monthly salaries, the liabilities that you have to pay with the ATO. And this business is going to shit just because of the fact that they haven't managed their cash flow. So that's the most important thing for small businesses, I find, when it comes to looking at the balance sheet, is to look at the cash flow. So you can't tell that by just looking at your P&L. When you look at your P&L, you think it's good. But then when you look at your balance sheet, you realize that by understanding how cash works in the balance sheet and how much money is in your bank account, if we changed this and went back to originally, it was showing as $90,000. $90,000 was going to be able to pay off all my debt, and also, if I had any monthly salaries and monthly expenses, divide that by 12. I also could afford 20K per month as well. So therefore, my business is healthy. Okay, so that's the big difference of not understanding balance sheet and applying it to your P&L to just see if your cash flow is good. And that's the reason why cash is king. All right, the last thing I want to teach you guys is taxes. One thing that you need to understand about taxes, and this is where I'm going to bring these closer together, is I tried to get ChatGPT to do a good job of this, to explain taxes to me, to put in the taxes in here. But you see at the bottom of here, when you make 240K, there's a tax bill of usually about 25 or 30%. So if I do that divided by the net profit, it's about 25%. So that means that if you forecast or you're going to be making $195,000, you can go into your P&L and go, all right, how much money do I need to save to be able to afford to pay the tax at the end of the year? And that there is just literally this times 25%. So it's about $50,000. But during the year, you may have paid taxes already. So let's look into that. So when do you normally pay taxes during the year? You pay it in your business activity statements. So there's something called the BASs for clients. So we actually generate a business activity statement reconciliation that looks like this. So this is actually all your BASs for the whole year. And it's done monthly in this case. But this every quarter, we actually will report the income. So you got your total sales, which is here. You got your GST on your sales, your 1B, which is GST on your purchases, your wages, tax, and then also they call them PAYG, which is your prepayment of income tax. Okay, this one's messy. I just wanted to show you a sample version of it that me and the guys in the accountants do. But I got ChatGPT to prepare one for you. So ChatGPT prepared a BAS rec. So throughout the year, we lodge business activity statements for you per quarter most of the time. And what they do is they lodge a total amount of 600K in sales, and then $54,000 is GST. Yep. So this here, you can see 600K, and this is 600K. Okay, this is a bit wrong how they done it, but look, let's not go into detail. If they showed 600K here in G1, and then it should technically be 55,000 here, because 550,000, because it should be net of GST. But let's ignore that. ChatGPT isn't the best at producing the BAS rec for me. What it also did then is throughout the year, I would have reported all this income and expenses in my zero. So we'll grab that information per quarter and we'll work out which one has GST and then report that to the government. And that's your GST on the purchases, which is your 1B. Also, on top of that, because you've paid 180K worth of wages, there's also tax on that. So what the accountant or what you do in the zero is you report the tax, the withholding tax on your gross wages paid. So that's your PAYG, which is W2, and that gets reported to the government as well. So throughout the year, you pay taxes, but get this, you haven't paid income tax yet, right? So it's just GST on your sales, GST on your expenses. So that's 54,000 minus 6 grand. So 54,545 minus 6,820. So you've paid GST of this much, and then you've also paid wages tax of 41,000. So how much did you pay altogether? You paid about $88,000. So a lot of people, first-time business owners, go, I paid $88,000 in taxes. I should get a refund because that's so much taxes. But that little did I know that the money that they've actually collected for the tax office isn't even to do with your income tax. We haven't even calculated that yet. And we've calculated it here at $48,000. So what do you guys think happens? They pay that $48,000 when we lodge a tax return. So that's on top. So that's the part where a lot of people get caught out. When we do the BAS rec and we show that to the clients, they go, oh shoot, I haven't even covered for the taxes for throughout the year, the income tax. And when you first start your business, we don't actually know how much profit you make. You might end up with a loss at the end of the day, so there is no tax. So therefore, you got to be careful. You're paying your taxes throughout the quarters, your GST, your wages tax for your employees or yourself. But the last thing you haven't done is PAYG installments, which I got ChatGPT to produce a summary again. They produce the summary per quarter. So if you've been in business for more than a couple of years, over time, the ATO knows now that you're making a profit every single year. So therefore, they lodge something in your business activity statements. And if you've been in your second or third year in business, you'll know what it is. It's called PAYG income tax. Yeah, it's called, they call it 5A, PAYG income tax. And you probably have seen it. You sometimes see it in your personal name as well. So this is a BAS rec. This is the total sales, 600K. See how I say 600K? This is the GST, the 54K. And then there's the 1B GST, which is the GST on your purchases, and then the wages, and then the wages tax. So the total tax that every quarter that you're paying is 24 grand, 26 grand, 25 grand, and 25 grand. This here includes your prepayment of income tax. So I wanted to bring this to your attention is like when you first start off your business, this amount here never gets included because no one knows that you're making money. But then after the second year, third year, you start making money. What happens is that the ATO knows that you've made the money, so they make you prepay this. So I know some of you guys have actually asked me, well, what the heck is this PAYG thing? It's pretty much a prepayment of income tax. If you lodged in the previous year that you've made money, then most likely they're going to, send you a quarterly PAYG in your business activity statement for your business. And what would happen is you pay up to 35K, and then your total BAS goes to 100K for the whole year. Then you've actually prepaid some of the income tax. How does that affect your profit and loss? If you pay $48,000, if your tax bill is $48,000 because of that 195K, and you've paid 35K throughout the year, that means you're left over with what? 48 minus 35, 13K. Hence why income tax payable in your balance sheet is $13,000. Your business activity statement doesn't always include your income tax if you don't prepay tax. So you need to prepay income tax here, and you don't ever do it in your first year because no one knows that you've made money. Maybe even your second year, you may have not made money, so you don't prepay it. But then after you lodge a tax return that you've showed profit and paid taxes, the ATO then starts making you prepay some taxes. And as a result, once you prepay some of these taxes, it offsets how much your tax bill is at the end of the year. And so therefore you don't pay as much, and it's only 13,000 as opposed to 48 because you prepaid it during the year. And that, my friend, is financial literacy and how it affects how everything is relatable. That's how BASes impact your profit and loss. That's how it affects your balance sheet. And that's how your net profit affects your income tax at the end of the day. And how does your cash, your trade receivables, money that doesn't actually get received, affect your business and the cash and your decisions. And by knowing all those, that's where you can make better decisions. If you understand how much tax you need to pay by the end of the financial year, how much you should prepay now, as well as how much money is sitting in the bank and how much you need to spend later on down the track, it makes you make better decisions. And so you don't go taking all the money out to buy investment property. You don't go paying for an employee when you don't actually have the money to do that, or you don't go investing in an asset when you can't afford it. Or it helps you also set KPIs to make sure that employee or that asset actually makes you money. The ATO decides to take money from you in advance based on the history of net revenue. Yes, 100%. So showing basically if you report that you made 119,000, I did a trick here. But if last year they reported 2023 taxes, right? And the income tax was 0 at that point of time. That's an error. Obviously they were supposed to pay taxes on it, and the tax was 25%. It's $29,000. So have you noticed that in the BASs here, they pay 35K this year. So in 2024, they pay 35K, and then the year before that, they pay 29. Okay, I purposely did that because I put it like a bump for inflation, a bit of a small higher bump. Because what the tax office does is they look at what you paid last year and they bump it up a bit because of inflation and all that stuff. And then that's how they determine how much you should prepay every quarter, just so you know. So this person lodged this tax return, worked out that it was going to be 30 G's in taxes. As a result, the ATO the next year, which is 2024, started making them pay 8,750. Okay, that doesn't always happen. And the reason why it doesn't happen is because sometimes no one lodges their tax return on time. So therefore, the ATO doesn't even know that you've made a profit for 2023. So when you're doing 2024, they won't tell you to prepay taxes because you haven't lodged your taxes at all. So they don't even know that you made profit. So the biggest issue of a business owner is that they don't actually, okay, great, I know how to look at these, but it's so much work to look at this. It takes a lot of effort. And I know because when it comes to personal training, it takes a lot of effort for me. And I know one of you guys are a personal trainer. So, so I can't stand it and I don't do it. So what I should give you guys are shortcuts, things that you need to think about that you need to do, just like personal training. So personal training, for example, is you just need to make sure you cut this out, sugar. Cut sugar out of your diet. Walk 10,000 steps. These are the easy things that you need to think about that if you just do every single day, you will 9 out of 10 of the times be healthy, or 90% of the time will be healthier than most people. So this is what I'm going to give you guys as well. So what do you need to know? Obviously, every dollar that comes in the bank account, I recommend having like 30% of that taken away and put it into a savings account for the business. So that's a thing that I reckon is really important for you. And the reason being is because, yeah, sure, that 600K is not all your profit. But if you take 180K out, have you noticed that 180K, and what I calculated before, I calculated the BAS tax bill was going to be about 100K. So it covers for your taxes. It covers for your super as well, 10% on that. So super would have been 10% on this. Oh, no, 12%, sorry. And also it covers for your leftover taxes, which is the 13K. And you'll have some money on top. So usually 30% is usually a good number. So what was that again? 100K here, that amount, plus the extra tax that you're paying here. And then you're left with 138. So you're always got some money on top. That's why 30% of your total sales usually is a good figure to keep. What else is a good figure? Here is really important. Remember how I said cash is king? 3 times your monthly expenses is a good idea too. So for example, keeping 3 times your monthly expenses in your cash at bank is a good idea. So what I mean by that is what you should do is you should add up your total expenses. It's $405,000 for the year. divide that by 12, times it by 3, it's 100K. So you want to have 100K sitting in your bank. Okay, that's a good habit to have. Right now, this person's got 90K. I'm comfortable with 90K, 2 to 3 times, okay with that. But $10,000, nowhere near enough to be able to afford. But 3 times, you're very conservative. You're going to have enough money to, if something breaks in your business, you're still going to be okay. So that's how I see it. And usually that's 3 times. 3 times is a very conservative amount. You could probably do 2 times if you wanted to. I currently, at today's date, do 2 times. And it's just because I run my numbers really well. Another thing is making sure that your trade receivables is low. So your trade, if you send invoices out, so not for the gym guys, you don't need to worry about this. But for the people that send invoices out, trade receivables is important. You don't want trade receivables to be more than 2 months of your income. So what do I mean by that? Scary, because that means that it takes you 2 months to be able to receive that money. Okay, so there is a problem because your money is taking so long to get to you when you make that dollar. And if you're doing that, that means that you're paying for all these expenses and it's taking you 2 months for the money to actually come into your door. So the time value of money is really important. Yeah. So try to keep it usually 1 month, 1 to 2 months. For me, it's like 1 month or less. So I keep my trade receivables at month. And how do you keep it down? What you're supposed to do is make it easier for your clients to pay you. Obviously, I understand some businesses that work with the government. Well, the government's good now. They pay really fast. But some businesses, it takes longer for them to be paid. Especially if you work for Woolies, for example. They have like 60-day terms. So as a result, it takes them ages for them to be paid. But if you can do your best to try to reduce this as much as possible, then it's actually a good idea. Okay, so I think they're the main things. Obviously, always keep an eye on your current liabilities as well, making sure that your current liabilities doesn't surpass your cash or trade receivables. Like basically anything that you can convert into cash is also important. So your current liabilities is showing $100,000, then you got a big issue. And sometimes your current liabilities does show $100,000 compared to here. And I'll tell you why. It's because you've got something called director's loan in here and you've taken the money out. So that's a scary thing as well. Or you owe the director or you owe someone money. So you've taken all this money out of the company, or the company owes you that money, or you've like borrowed money. And so yes, you've got this money in the bank account and you're making profits, but the money's not, you don't have enough to pay for your current liabilities. And that's where it's a significant issue. They're the main things that you need to be careful of. As long as you track your numbers, do your bookkeeping, look over your, take 30% of your income, put it away, and then obviously look at your trade receivables and look at your cash at bank on a regular basis, then you're fine. You'll be pretty healthy. And the first tip I always like to start with is focus on the right metrics at the start of your business. When you start your business, I've realized that you don't actually sometimes know what your business plan is. But if you know what the right metrics are, so like what you're aiming for, what your goal is it short term or long term? When I first started Box Advisory Services, I didn't really care too much about the profit. I just didn't care. And I knew that if I was running an accounting business, the whole goal of running an accounting business is that you've got sticky clients. And when you have a client, most likely they don't want to leave because it's a lot of work to leave and move to another accounting firm. I knew that model is very sticky. So my goal for the first 5 years was all about growth, all about customer retention, and it had nothing to do with net profit. So when I ran my business, I started the business, of $20,000 in my bank account. But I basically tried to use as much money as I can and minimize how much to pay myself because I didn't really care too much about making money in the first few years. And because I knew that was what I wanted to do and the metrics I wanted to aim for, I only cared about growth. And so I was like always thinking, let's double my income every single year. Like income meaning fees, like so my turnover. And so that's what I aim for. So let me just quickly share my screen. All right, so this is a profit and loss that I like 2018 to 2024. Obviously, these numbers are not completely accurate. Things have been edited out, but most of it is like you get the general idea of what the numbers were. So when I first started the business, it started in 2016, but 2016 to 17 was a bit of a blur. So and also I moved from a sole trader to a company. So therefore I just removed that period because it's not a really good explanation period. So it's not really it's a period where I went on 4 holidays as well. So it just removed that out of the question. So basically in 2018 to 2024, you see that I have significant growth, especially in the first few years. Like I grew from 210 to 334K, 500K, and then 900K. But you will see slowly over time from 2021 to 2024, my growth starts diminishing and it slows down. I'm happy with that. Most people will look at this and they will freak out. But when I first started the business, I had this key goal that I wanted to achieve, which was as quick growth as I can and to make sure that I can retain these customers. If I can grow really fast, retain customers and look after it, then my income will go over $1 million eventually. So once I ticked over the $1 million, which was about 2022, I started thinking, okay, I don't need to go for growth anymore because I'm making $1 million. Now I need to refine my business. I need to fix the processes. I need to make sure the quality of service is great. I need to train my team members and I need to focus on net profit. If you scroll all the way down to the net profit side, you would see that like here, I'm making a profit. You think that I'm making a profit, but if you take in consideration the actual wages that were paid, you'll see that in the first few years, I didn't really pay myself a wage properly. And I still don't think I paid myself a proper wage until like 2021, I think 2021, 2022. And if you look at that, you'll see the growth in wages. So I think here from these first 3 years, my wages were actually quite small. I paid other people more. Actually, hired a senior accountant, and that senior accountant was making more money than me. So that's what I did. My focus wasn't the net profit. So all the money that I made, this profit here, you don't see it, but it was actually reinvested back into hiring more employees. So see how I made this money? I made 200K. My goal then was hire $200,000 worth of employees. And I probably paid myself around $80,000 in my third year of running a business. And then obviously I kept myself at about 100K for the next few years and just kept hiring more and more people. You see it stagnates here, but it doesn't really. I just move my expenses, my cost of goods, wages I just split my wages properly. So what I did in 2022, you think that my wages actually hasn't increased, but it has extremely increased. So you'll see that I just pushed some of my wages over to here to just split it properly. I just want to see the difference between my accountants and the people who run my business, who support my business, which are admin, marketing, and sales people as well. So you'll see that like I've actually in the next 3 years from the next 3 years of running from 2021, I actually started slowing down my growth and focused on actually improving my services and getting more out of the services that I was making. So I started improving the efficiency. I started getting jobs done better. And as a result, like my focus now is the growth of net profit. So you'll see slowly over time, my growth of profits starting to increase. It was at 10% at one point. You think that 34 to 17% here is my net profit. This is 329 over the turnover. But during COVID in 2021 and 2020, we had some COVID grants and COVID income, not just like grants from the government, but grants as in the sense of like doing advice for our clients. So we had some like special work that we did. And surprisingly, we made money. We shouldn't have made money, to be honest. If we removed the COVID income, the business actually didn't make as much money. It was actually should have been at like a break-even point. So we got a bit lucky there. So as a result, we got lucky. So what do I do? I knew that my metric was to focus on growth. So I just bumped all my wages up. So you see there was a massive jump in wages I spent 800K in 2022 on hiring so many staff members. People think, oh, well, if I hire, all these staff members, I should see like massive growth. I should see massive profit. And no, I didn't. My growth just went up, yes, by 100K, but when you look at the net profit margin, it's actually only like 1% extra from last year. So is that wrong? Do people look at that and go, well, I shouldn't hire anyone anymore because it doesn't make sense? So I just want to go back to it. So my goal when I started from 2021 onwards was just to slowly improve my business. And it's going to take time. I know that hiring all these staff members is great, but when you first got your job, like when you first started in your role, it takes time for you to get used to working in the business, and then it takes time for you to get good at your job. And then also you got to train the team members. So my team members had experience when they joined, but the thing is, they didn't think too much about profit. And so therefore, over time, the last 2 to 3 years, we started setting KPIs up. And my business is a business that's still growing. So everyone that leaves their own corporate job and then starts their own business thinks that they can just, from the ground running, set metrics up, set KPIs up, set employees up, and from the first year, they should start seeing results. But when you start running a business, especially when you start a business from scratch, you can't automatically get these figures and you can't automatically hit KPIs and set KPIs that work. That's one key metric I realized when I started my business. I need to focus on the right metrics first, like as in I need to know what I wanted. And my goal was firstly to grow. And then the second goal is to improve my profit, the net profit. So now in the last 3 to 4 years now, my focus is net profit now. And I'm trying to figure out better ways to do things. Should I be minimizing my software? Am I hiring the wrong employees? Like, is there things that I'm doing that isn't correct? Like, am I selling the wrong product? So in here, I also have a split of all my income. So you see how there's service fees here? There's actually in my I've combined this together, but I actually have a split of all my service fees. And I've realized that some services aren't as good. So it doesn't make me much of a profit. So therefore, I should start deleting it. So anyway, the first goal is working out what your metrics are. So what are the right metrics your business should follow? And it's all about planning. Sometimes you get it wrong and then you have to restart it, you sometimes have to learn from your mistakes. So for my goals, I didn't have a short-term goal. I knew that my short-term was just to get as many clients as I can. So that was my focus. Every month I had a target and I would just focus on getting as many clients as I can when I first started the business. My long-term goal was increase my business to 1 mil and then start refining refining the expenses, improving the efficiency on jobs, stop the bottlenecks that I'm having in my business, and then look at net profit. And that's what's happening now. So what are your goals? What are your cash flow requirements for your business? What do you need to survive on? And you should then determine that, and then you'll know what your key focus is. Again, our goal was growth in sales, customer retention for the first 5 years. And then now 8 years in the business, we're focusing on net profit, and fine-tuning our processes, improving the next generation of accountants. So the next employees that we hire or the employees we currently have, we need to pass down the skills that I have down to these employees, because I've realized there's no way where I'm going to grow anymore without a good team that can do the work. And you'll see that we've actually stagnated, like in 2024 to 2025 financial year. Our growth, and I haven't shown that yet, but I can show it to you guys later, is that our 2025, there isn't even a smaller growth than we've actually seen previous years. Am I upset about it? I wouldn't say I'm upset. I kind of expected it because I knew what my metrics were. My metrics is not growth in income anymore. My metrics is growth in net profit. So if my net profit still keeps going up, then great. And it's still going up slowly, even though my growth in turnover is kind of stagnated. I've done things in the business that improved our net profit margins, And the main thing also I'm still focusing on is customer retention, quality of service. But some of that takes a drop if you're trying to train the next generation. Obviously, you can do things better. So second one is also quite similar. It's quite similar to what's happening right now with the numbers, is that marketing isn't always about immediate ROI. So when I started my business, I started spending money on marketing. My goal was to spend $10,000 and I didn't immediately get results. I obviously did get some clients from it. Some of the clients said they did watch my videos, but they also got a referral from someone else as well. But I knew that if I keep building my brand using the marketing and I kept getting better, then eventually over time, it's going to compound in ROI. And I'm going to eat up with the market share online. Market share being like, I'll just be in front of everyone's phones when they look at accounting and tax related questions. And then it will be very hard for a competitor to brute force beat like my marketing, because I've got videos about every single topic and it's the one that always shows up in basically all questions that get asked on Google, YouTube, or social media. So that's what my goal was. My goal was not focusing on the ROI. So in the first year, I had a budget of spending $10,000 on my marketing. I ended up tripling that. I ended up spending like $30,000 in marketing. And then over time, it kept increasing. And now we spend about $150,000 on marketing a year. And the concept is a lot of accountants, when they start doing marketing, and a lot of my friends, they call me up and ask me questions about my marketing. And they always say, well, what is your ROI on your marketing? I asked them, what do you think Red Bull's ROI on their marketing is? They've built a brand, and you'll see them in like skydiving. You see them on, extreme sports, and they're just sponsoring all these events. Do you think they track the ROI on their on those sponsored ads or sponsored branding? And it's really hard to quantify. If you're seeing like indirect benefits from your marketing, for example, your brand looks better, you're winning awards, your PR is good, people are talking about you, some things that you can't really quantify because you just you can't put it on a spreadsheet, but you can just see it happening. And I saw those benefits when I was running my marketing, doing my marketing. I saw people saying, hey, I watched your videos, or I saw clients even saying to me that I watch the video that you said, and I have another question to add towards that. So it saved me time in terms of my meetings with my clients now, because they ask the right questions. They already learned from my videos, and they're just asking a better question, so they get a better meeting, rather than me spending the whole hour or 40 minutes of my meeting with the client explaining simple concepts about accounting and tax when I could have explained it on the video. So they would just watch the video and they come to me and ask the right questions. I already know their business really well, and it works. I'll show you guys something crazy that I only just show some of my friends. But when I first started doing my videos in 2019, 5 years ago, some of them look like they've done well, like 8,000 views. But you'll see a lot of them, a majority of them, do really poorly. And they still do poorly to this day. So I released a video 5 years ago, 800 views. This one here is like the channel, so don't worry about that. This one here, 700 views. Yes, this one's bigger. We knew this worked. And this one technically didn't really work. This one worked. This one kind of worked at that time. Now it's dead. 800, 500. And yeah, so you would see that like more than half of my videos don't work. And there was some times where like a lot of the videos just never worked. But if I looked at the metrics, I would give up. Because I look at these metrics, it just wasn't working. If I looked at the ROI of this, is it going to make me money? No, it's not going to work. But I kept trying. And I think when I looked at a lot of businesses that do well, they trial something and they keep going. They keep trying to improve 1% at a time. And what we did is we posted these videos, realized it didn't work. Maybe it was a topic, or maybe it was the way I was speaking. Maybe it was the way the content was written. Maybe it was the thumbnail. Maybe it was the way I was done. So I actually started getting other people involved as well in the team. So I started getting some of my team members, you'll see later on down the track that you'll see that some of the videos are just other people as well. You'll see over time, there's so many chops and changes and things that I did to try to improve the videos that I was doing in the marketing. The main point of this topic, which is marketing isn't always about immediate ROI, is the fact that you can't always look at the ROI on marketing. It takes time to get the right marketing. And it took me ages to try to figure this out. And I feel like a lot of people, when they look at marketing and they want to spend money on marketing, because a lot of the businesses that want to keep growing, they always look at ROI, and sometimes it's like you shouldn't look at ROI. You should look at the indirect benefits that it's giving you. And when I started in marketing, I saw the videos that I was doing, I could send to clients, save me time in my meetings. Another thing was a help with branding, something that you can't quantify. So a lot of people saw me online, they knew about me, they spoke to their friends and family, but I can't quantify that because no one would actually put that on a spreadsheet, for example. Third thing is that I was able to even get all that information and send it in my email. So I had more ways to email my clients, more things to have touch points with our clients. And, probably the fourth or fifth thing is that it actually helped my clients understand and be educated. And so that indirectly helped my service as well. So there was so many different benefits that I was getting that you couldn't measure on return on investment. So yeah, don't focus on return on investment on marketing. Try to keep refining your marketing, and then eventually over time, in the long run, there will be a return on investment. Now we spend $150,000 in marketing. Try guessing how many clients and new clients that we get. We now quantify it. It's been like 8 years of marketing. 6 years of marketing now, and we can quantify it now. We get about 800,000 in new businesses a year. So we quantify it now. It's 800 over 150. So 800 over 150 is, I don't know why my calculator's not working. It's about 5 times multiple on our ROI. But that's over time. If I stopped in the first 2 years, there was no way I was going to get 5 times on my ROI. So yeah, first thing is when you start your marketing, don't focus on the ROI. The next tip is, does the market actually want your product or service? So this is actually probably chartered accountants, apparently chartered accountants, they did a topic about this in the course program. And they said that the number one reason for failure in business is that you build the wrong product or service. So if the market doesn't want it, you have nothing to sell. And I've actually been in this industry for 9 years, and it's crazy to see businesses being built, especially software being built, and no one's tested the product. Everyone thinks that it's going to be great. You speak to your family and friends about it, but you got this product that sure, people want it. Maybe they want it, but they're not willing to pay for it. And a good example of it, Google Glass Tech or something like that. I don't know if everyone remembers this product that was sold ages ago, back in nearly 10 years ago, Google Glass. So this Google Glass was this looking thing that people used to see. So nowadays, you're seeing it again. You see, I think some glass brands started to build something within their AI driven glasses, or glasses where you can actually see messages and you can start doing things. But this was a flop 10 years ago. They built a product that they thought was going to work, and it just flopped. And the reason why it flopped was because there was limited use cases. You couldn't even actually use the product. There was no softwares in place to use it. And the price was very expensive. I think at that time it was worth $1,500. And there was also privacy issues that all the information that was put into here, where you're filming everything and all your personal data might be released to Apple or Google. And that's the issue that this product had. And I find that a lot of businesses have that problem where they don't actually test their product. And a very easy way to test a product is basically, before you even have the product or service that you're creating, why don't you post on LinkedIn or Facebook group, and you say, hey, I'm new to this business. I'm starting something new. I want to trial this product to get feedback. And I've actually spoke to a lawyer about this recently. And the lawyer was like, hey, Davie, how do you get your first leads? And I said, do your work for free. Do the work for free for the first 10 clients that sign up, and ask for referrals. and ask for that feedback on how to improve your service. So, and I suggested to him maybe jump on Facebook and say, make a comment just being transparent, saying, hey, you're just starting a business. You've been in the legal game for the last 10 years, but you're going out on your own. So you need some clients. So your focus, tell them what you want to focus on, which is construction. So he wants to focus on construction. I said to him, why don't you test it out? Just post it on Facebook. It's free of charge for people, and people can then test the product, test your service, and see if you actually have any bites. If no one's going to bite, then you know that your product sucks. If people do bite, and then once you provide the service to them, you ask them that question: how much would you pay for this service? And so if they say they're going to pay $100 or $200 for the service, then you probably don't have a good product, because your time as a lawyer you charge out at $400, $500 an hour. So if you only do a product or service for and you only can charge $100 and you spend like 5 hours, it's not going to work for you. So that's how you test. But I find that a lot of businesses start, starting a business and charging all these fees, and they think that it's because they want to they're not getting clients because they need to spend more money on marketing, but they don't realize that the product or service they have is not good. It's not something that's wanted, or it's something that's wanted but not at the price point that it is currently. And so therefore it's just not a good business model. And unfortunately, if it's not a good business model, you should stop doing it. That's just what you need to do. And I think a lot of businesses don't do that. They think that they could just spend more money on marketing, or they just spend more hours doing the work, and they don't realize that their product or their service that they have is the wrong product or service they should be selling. Yeah, it's quite unfortunate. And honestly, we have that same issue as well. So personal returns in the accounting industry is not worth doing. We spend way too long trying to advise the client on the work, and we only can charge about $200, $300 for a personal return. Whereas a client will want a 1 hour meeting with you to go over the tax return. They will also want you to prepare the tax return with no mistakes. And the ATO wants us to review the work and go through the whole process of getting it signed, all the documents filed, all the work papers filed, all the client's invoices filed. By the time we finish the work, it would have cost us like $300 in cost, paying an employee, getting the softwares, providing all that, like all the information. So it's actually not worth it. Whereas we can't go back to the client and charge them $500. The client's not going to take it. So therefore, recently, in the last year or two, we decided we're not accepting any more personal returns. But if you're running a business, it's a different story. So if you're running a business, you would notice that we still do your personal return. Because sure, we don't make any profits on it, but it's based on the business taxes that we can make profit on. So we've decided that to stop all tax returns moving forward, like all individual tax returns. So that's why you can see that there was a bit of a drop of our income, and that's why hasn't increased as much. Yeah, so there are things that we do to understand like if that's the right business for us. One issue that I find a lot of businesses that make a lot of mistakes and don't improve or not very successful, the biggest problem that they have is the lack of focus. So when you have lack of focus, what happens is you have lack of direction. And then as a result of that, it results to lack of quality or service. So lack of focus results to lack of direction, and lack of direction results to lack of quality of service. A lot of accountants have this problem. So sometimes when some of you probably have had other accountants before, and if you notice the accountant's really good at what they do at the very start, and then over time they become a broker, or over time they start selling you insurances, or they start becoming a financial planner and they ask for investments or helping you invest, and then they're not a good accountant anymore. You don't even know what they're doing anymore, because they're trying to help you get loans, which they're not good at. But they spend so much time trying to focus on getting loans for you that they don't even spend much time on being an accountant. And as a result, they're just not good at anything. And this happens a lot when you start up your business or when you're running your business, because over time, when you're running your business, there's pros and like it goes up and down in business all the time. So sometimes you're growing, sometimes you're slowing down and you go down a bit. And at that point where you're stagnating or plateauing and going down a bit, a lot of people have shiny object syndrome. And it happens usually around this time, December, January, where everything is slow. So everyone's leading up to Christmas. You see this massive high that money's like transferring everywhere because everyone wants to spend their money because it's Christmas. This happens in retail. And in January, everyone's over the Christmas spirit. Everyone's needs to save now. Everyone needs to knock it down and work. And so therefore, no one wants to spend money. And as a result, it goes down. So you get this massive high, this cheap high that you always get. And then it goes a massive short downward spiral. And then at that time, you go, all right, what can I do to make more money? What do I do? So, you know what? I'm going to start selling insurances, or I'm going to be running a mortgage brokering firm. I'm going to start learning that. So I'll learn to pick up new skills. And the result of that is you forget that you're running an accounting business in my situation, and you've got clients that you're already servicing, and these clients want the quality service as an accountant. And there's so many things you can do to improve your services. Like I've been an accountant for 17 years now, and still to this day, I'm still learning things, a lot of things over time regarding accounting. Day by day, I'm still learning new things. And so I think what you need to focus on is being good at what you do first, being known as the best accounting firm out there, or whatever service that you provide. And then you can open other channels of income. Yeah, so I've been in business for 9 years now. Now you'll see that I'm starting to refer, I'm still an accountant. I'm not even doing anything other than being an accountant. And that's a good thing as well. So clients then see that Davie's not trying to be a broker and all that stuff like that. Because most accountants out there become brokers. It's crazy how that happens. Number 5, a big topic about this is focusing on getting better, but not bigger. This topic here is a bit weird because my first few years was focusing on growing. But then what I learned from, and growing as in like numbers, like I wanted $1 million in fees. I wanted like a big client base. I wanted like 300 clients. And then I want 1,000 clients. Now I want to aim for $10 million in fees. And then it's only recently in the last couple of years, you've seen my goal shift. I've realized that because I'm focusing so much on growth, my quality of service hasn't been the best. I want to do better. I want my quality of service to be better. And hand on heart, like I really care about my clients and I really want to provide the best services I can. And so over time, I've realized that I need to focus on getting better at what I do. And this ties to the previous point where like the metrics, remember how I talked about the metrics? I've now changed my metrics. My metrics now is getting better at what I do. And being better at what you do results to, more clients wanting to work with you. But in the long run, that happens. In the very start, that doesn't really happen. And there's this concept. I think there's this concept that my good friend Can always talks to me about. Because when I first talked about marketing, I always cared about the growth that I had and how many views I get. There's this book. It's called The 1,000 True Fans. So Can always told me that it's not a focus on how many videos go viral or how many of your subscriber counts are. Our goal was always just to get the right quality of clients or audience on our YouTube channel. It didn't matter how big it was. So initially when I first started, there was only 500 subscribers, 1,000 subscribers. Whereas I saw these YouTubers or everyone that was doing all this marketing blow up really, really fast. But what really, really mattered was the income and the numbers in my business. Is my business making money? Is it growing? Am I hitting my goals in my business? It's not about, the viral videos or the viral marketing. It's about the 1,000 True Fans. It's a really good book. I haven't read it. I've read the summary or watched the summary online. And it talks about basically instead of aiming for 10,000 clients or audience that pay you $100. So 10,000, $100. that gets you to your $1 million in fees. Instead, go for 1,000 that pay you $1,000 instead. And that will get you to $1 million, and it's easier to handle. And those clients are your true fans, and as a result, they'll refer you more clients. They'll bend over and backwards for you as a result. So it's not about trying to focus on getting bigger. It's focusing on getting better quality clients, providing a better quality service, and improving your service over time so you can actually get true fans. So that's kind of something I learned over time. I think my goal was always just about growth, and it's stuck with us as accountants, because when you first give up your career and you focus on starting a business and you go to mentors, and all my mentors always kept saying, Davie, in order for you to run a successful business, you need to get $1 million in fees. And I think they learned that because when you buy into a partnership in KPMG, they have this KPI, and the KPI is set that you have to have $1 million in fees. And then now over time, accounting firms are starting to say, you don't need $1 million in fees. You just need to have a good quality of service and a good quality of clients that will pay you X amount of dollars. And it's about the net profit or whatever you want to aim for, or it's the lifestyle that you want. But then I kind of got blinded by my mentors or my bosses at that time that said to me that you need $1 million in fees. And over time, I learned that that's not really what I needed. I just need 1,000 true fans. And we're at that point where we've got 1,000 clients now, 1,000 business clients, and over 1,000. And our goal is now just fine-tuning our services again even more, and providing a really good service so clients are happy and they become our true fans. Another topic is remember to spend time on your business, not just in it. So I think this is a problem that everyone always talks about. It's something very cliche, and accountants have this issue as well, where I think I'm a very good accountant. I think I'm very good at it. I love doing accounting work. Every time I have a meeting with a client where I can help them save money or help them improve their business, I just get this natural high. And what I also really, really hate is managing a team. I just can't stand it. I can't stand talking about career growth. I can't stand hiring people, recruiting people, meeting, and then sometimes having to deal with their problems. I just can't stand it. I feel like it's such a waste of my time. But in the business, no one else is going to do it. And if you're not the one that's going to do it, you'll have to pay someone else. But if you pay someone, it may not be efficient. They may not be good at what they do because they don't know your business. And also you may not be able to afford it. And at that time, when I first started my business, I could not afford anyone to do recruiting. I could not afford anyone to do HR. And so therefore I had to do those roles. Was I the best at those roles? No, I sucked at it. And I still probably suck at some of them. And the one thing I'm trying to learn right now is to be a proper CEO, proper director, a manager that manages the business and then allocates work down, aligns the work and provides service resources to the team members. What I've realized that in running this business is there's key functions in your business. In my business, it was sales, marketing, recruitment, finance, admin, and the last one is operations. Some periods of my time running a business, just wanted to do operations. And I think if you want to grow this business into a bigger business and you want to be a successful one, you need to jump into sales, you need to jump into marketing, you need to jump into recruitment, finance, and admin. It's funny, actually, you have to wear all the hats. And once you establish those hats and those departments, then you need to start finding the right people to delegate that work to and to handle those departments. So it's funny because I actually feel like I can do sales, marketing, recruitment, finance, admin, and operations now. I can do all of them. And that's a great thing about that is then now I can find the right people to do the work. And currently, I still do a bit of the marketing. I still do sales, but my focus now is to manage the team and look at the numbers and all that stuff. Eventually, over time, I won't be the numbers guy in the business anymore, and I'll delegate that work over to an internal accountant. But right now, we can't afford an internal accountant because internal accountants, as you know, as you guys know, accountants are quite expensive. I actually want to share you guys a story about this, actually. I have this client, he's a mechanic, this guy here. is definitely not this guy, but I just figured I'll just show you guys. Let's give him a name. His name is David, actually. David the mechanic. So David the mechanic, I've been his accountant for the last 3 years. He started a new business and he was a really good qualified mechanic. He's been a mechanic for 10 plus years, and he's worked the hard yards. He was a apprentice. And when you meet this guy, you know he's a good mechanic, because every time you meet this guy, his hands are always like dirty with oil and all that stuff like that. He lives and breathes being a mechanic. He knows everything about cars. And so the opportunity for him was to start a mechanic business. It came up for sale. It was a startup business. It was like a franchise. And so he started it. It's been like 2 years in business. And he was at the very first start of the business. He was doing okay. He was doing really well. But over time, it's kind of stagnated, and it's slowly, he hasn't slowed down. It's still growing. But the problem with his business is that he's got this clause with the franchise. He's got a rent-free period. So the first 2 years of rent is free. So, and then the second year onwards, it's half price. And then in the third year, it's full price. So the mechanic thought, great deal. I have 2 years to run this business and start it up. And then once the business gets stable, I'll pay half rent. And then on the third year, I'll pay the full price, and I should be able to afford it. So the business, then when it first started, was going well. It was growing really, really fast. And then over time, it stagnated. It could have stagnated because he told me that there was a competitor that opened up shop like very close by. And as a result, they're taking some of the clients as well in the local area. And I said, look, David, you got to focus on marketing. You got to do more marketing, sales. And I was like, what's happening with your numbers? Like, who's your mechanics? How many mechanics do you have? And he said, I have 3 mechanics, including myself. And I said, do you need 3 mechanics on the floor always working? He said, no. And I was like, oh, do you think that you can get more clients in to fill the space for the 3 mechanics? And he said, yes. So I said, but you need to focus on marketing to get more clients in. And for the last 2 years, we've been talking about the same thing. Every single meeting we have with him, I'm talking to him about increasing his income, increasing his growth by using marketing. And I think the last 2 years, the only thing he's done is hand out flyers and set up a Facebook page. I think the reason this guy's failing is because he's not willing to stop being a technician in his business. I think he's very good at running a business, being a mechanic, but he just can't stop getting out of his technical skills and hiding away from it. I think this is just a clear tip for you guys, that even though you suck at the skills of sales, marketing, recruitment, finance, admin, you went into business, so you should focus on that, because that's what you need to be running a business. And when I hated doing sales, when I hated doing marketing, when I hated recruitment or HR and my team, I still did it anyway. And even though you're not going to be good at it, and over time you're going to get better. It's just the way it works. So stop being that mechanic, David, where you just hide away on your tools and just focus on doing fixing cars. Focus on the skills that you need to run a business. And when you realize how to run a business, and when you slowly realize that it's really, really simple. You need sales, you need marketing, you need recruitment, like bringing in recruitment as in getting resources. You need finance, you need admin, you need operations, and you need IT. Some things you can outsource, like you can actually outsource it, but it's a very good idea to have at least understanding of it so you know what you're outsourcing. And that's sometimes you got to do it yourself. Unfortunately for David, he's at this point now that he needs to make a decision now. So whether to refinance out of his home loan to support the rent, or he needs to close up shop. We've already had that conversation with the client, and he needs to come up with that decision. Okay, I got 2 more tips, and I'll be quick. Number 7 is, as you grow, ensure you're revisiting your systems and processes and fine-tuning it. So for example, I have this phone system, and I think I've said this to a few clients before. I have this phone system that I used to have where it's a 1-300 number. Every time you call the 1-300 number, it'll go to my mobile, which is hit my mobile and I'm all good. And then what happened was that I'll pick up the phone and just go, hey, it's Box Advisory Services. How can I help you? So when I first started the business, this was a very great process. But when the business started growing, when I have now 30 staff members and I've got like thousands of clients, what happens is during the process of the day, the admin person, I've given the phone to the admin person now. The admin person takes care of all our reception phone calls. However, the admin person for the first half of the day is calling the ATO, is calling clients. So she's always on the phone. So now, because I've set up this system where if no one can call through, it'll go to a voicemail. Literally every client, not every client, most clients are calling and they can't get a hold of us because the phone's always busy. So I set this process up that worked at the start of the business, doesn't work now because we have too many clients now. We have too many processes and systems, too many people to reach out to. So a lot of clients are calling this number and they want to talk to someone else, but they can't get a hold of it. So we had to improve the phone system. So about a year ago, we improved the phone system. We set up like two phones that gets calls. And now we've revised it again, like recently, that now we have departments. We have to have a phone system where you can call this number, will reach a hotline, then you can dial for 1 for this division, dial 2 for this other division, dial 3 for another division. And also there's a voicemail, but the voicemail goes to different divisions and the emails get sent to like the whole team. And that's just, it's weird, but we have to improve this system. So I'm using the phone example as your business. It doesn't just have to be the phone. It could be like your business itself. When you had the way you do things before, back then, I used to review everything and I had a very simple way of doing things. But now that we have more layers and more team members, we just had to keep improving the system. And sometimes you got to realize that sometimes when you grow so fast that your systems and processes, it's kind of like pointless to build a system because it becomes redundant in 6 months. So just spend the time on building a system and process that maybe could be future-proofed, or sometimes look in the future a year later and build a system for something that's for next year. So when you grow to that point, you don't have to redo the system again. So if I just got another phone, I don't think it would have solved the issue if we grew to 30 staff members. It's better to just actually properly build a system properly. And it's unfortunate, but we lost a few clients because of our phone system. We had some clients actually say to us that can't get a hold of you, and it felt like I'm paying you all this money and I just can't even call you. And another thing was it wasted a lot of my time because they couldn't get a hold of the phone system and calling my team, so they kept calling my mobile instead. So I spent a lot of time dealing with simple questions. And it's funny because I used to hear it all the time. I used to get all my clients saying, "Hey, Dave, I'm sorry to disturb you, but I can't call your mobile. Sorry, I can't call your office number. I have a simple question. Can I just bother you for 5 minutes?" And it happens so many times. And so therefore it wasted a lot of my time and I couldn't get involved with the proper work that I was supposed to do. Last tip was hire according to the needs of your business. And this is where I'll answer your question, David. I think when I started running the business, I realized that when you're scaling, you need to focus on the business and not be in it. And you're going to need someone who knows what they're doing so you can take on the work. You won't have the time to actually teach them. So for example, when I hired my first employee at the early stages, I find a lot of people make mistakes and they hire like a junior or admin person. But for me, my goal was to increase the growth of the business, increase the fees. And so I think at that point in time, I made a decision to hire a senior, like a more experienced accountant, so they can focus on doing the work with less supervision, less training, and I can focus on the other hats, which is marketing, sales. So you need to know what you're hiring for. And I think some people, they look at how much money you can spare in the business, and then they hire like a junior or a intermediate, and they say, "Oh, look, the business can't afford it. I can only hire a junior or someone that's inexperienced, but I can train them, so I'll just train them." But the biggest problem with the business was with growth is like they can't handle the amount of work. So if you hire a junior or someone that's inexperienced or someone offshore, you're going to spend a lot of time training this person, and you're going to spend a lot of time reviewing the work. And so I found a lot of clients make mistakes where they spend their time hiring this person, and yeah, sure, they're paying them a small amount of fees, a small amount in wages, but they end up spending twice the amount of time to do the work, and it becomes inefficient. And then they end up realizing this person's wasting their time. So they end up firing that person, and then they're hiring a senior. But then they spend a whole year training this person. It was a waste of time. Like, you really need to know who to hire. And then, for example, in the mature stages, as a junior, intermediate, you then in the mature stages, you then start hiring juniors and intermediates, like people that with little experience, because you got managers to train those people. You got experienced people within your business that will upskill them, will mentor them, that would supervise them. And so you just need to understand the business model. For every business model you have, every stage that you're at, you need to hire the right people. So that's how it works. How do I find the right remuneration for my employees? So over time, I've tried to improve on it, but my mentors, when I first started my accounting business, told me that you need every employee to 3 times their salary. So the way you need to understand your business model. So my business, the metrics is for every dollar I make, 1/3 should go to labor. So like to pay your wages and like superannuation and all that stuff. And then the other third should go to overheads. So overheads being software, training, rent, and all the other expenses, as well as managing and marketing. So that's overheads as well. And then the other third is profit. So that's how the model works. And so what I then decided from that key metric, I've decided that I should tell my team that. So I was very transparent. I said to my team that if I hire you for, say, $80,000, I want you to $80,000 plus, including super. I want you to 3 times your income when you come to me. So I want you to make about 240K in income. Yeah. So how are you going to get 240K? So then I needed to build a process or a system or a platform for them to be able to track how much work they're doing. So I worked at, for every job that I give a client, it's so easy for my business to be able to do this, but and I'm sure some of your businesses in professional services or selling products will have the same situation. But remember how you guys signed up with me? The first thing you would have saw is this pricing page, right? So this pricing page here has $300 a month. So if I were to charge people $300 a month, times that by 12, it's $3,600. This $3,600 is technically the average fee that our clients charge, maybe a bit more higher. It's about close to about $4,000. So say it's $4,000. I've split that $4,000 between the different services that are provided in the departments. So annual tax returns and financials together, the actual fee of that $4,000 works out to be $2,500. So, and that annual tax return, that portion of $2,500 is done by the accounting team. So I said to the accounting team, you need to do $2,500 for the $80,000. Actually, let me do this in a spreadsheet. I think this is more easier to understand if I do a spreadsheet for you guys. So say your wages is $80,000, right? Well, the employee that came on board, that's including super. So let me just fix this up, make this look a bit nicer. Yeah, $80,000. My KPI for the team is 3 times. Times 3. Okay, times 3. And then I explained to them is 1/3 of this is profit. The other third is your wages, and then the other third is overheads. So then I said to them, all right, well, how do I make up this 240? So I said the average client that you do work for is, and your portion of it is 2,500. And I worked that out by like looking at the numbers that we've made for the whole year. So I looked at the average income for clients. I looked at the services that were provided, and I split it up. And like I said here, when I did this, there was BASes that was done in a separate team. These were done in the tax team. This was an email from the overhead, so this is like, doesn't cost that much. Then there's accounting, training, and setup, and then there's phone call support. So I've actually separated it. I said, all right, 2,500 is for these 3 here. And then obviously this one here is about $500 a year, and this one here it's about $1,000. That's what adds it up. So if I go 1,000 plus 500 plus 2,500, that adds up to the $4,000. Remember how I mentioned to you guys the average fee is about 4,000 for a client? That's how I separated the services that we provide and how much the portion of work gets done by each department. Then I said to my employee, all right, you want $80,000. That's okay. You need to do 3 times your expenses, like how much it cost me. And for the whole year, you need to do about 96 jobs. 96 of those clients. You need to handle 96 of those clients. And I just gave him a number. How much is 96 divided by 12? It's 8. So you just need to do 8 jobs a month. So now we set a KPI on 8 jobs a month. If you meet those KPIs every month, then come back to me, ask for a pay rise, because you're hitting this, and you probably could aim for 90. So if, for example, if the employee comes to me later and says, I want a pay rise for $90,000, and I just say, okay, well, are you hitting 9 jobs a month? If you're hitting 9 jobs a month, then I should give you the pay rise. Or is there a plan for you to hit the 9 jobs? Or should I increase my KPIs? I had a performance review one of my team members, and they asked me what's a game plan for me to get to X amount of dollars a year. Like say they were on 80,000 and what was the game plan to get to 100. So I just drew it out. I said 90,000 is 9 jobs, 100,000 is 10 jobs. That's all you need to do. And then they said to me, so what if I don't hit the 9, I shouldn't ask for a pay rise? I said, no, technically no, but you need to explain to me what else are you doing indirectly that's making income for our team. So I said, okay, say that you're not hitting the 9 jobs. Let's just cap it at 9. Let's just say that 9 jobs is what I only need from you. But what you're doing is managing a team, doing other things. So I can set another KPI for that. So you now manage this employee, but I expect this employee, this junior accountant, to be able to do 3 times their salary or 2.5 times their salary, whatever it is. So I want them to hit their goal, and I just want you to hit 9 jobs a month instead of 10. And then I'll pay you 110,000 because I don't care about the extra 2 jobs because I'm getting another team member to do it, and they cheaper, more profitable, but also you're training new accounting team members for me to scale. Yeah. Does that help answer your question, David?
Yeah, that's really great. Yeah, thank you. I'm trying to think through all of this at the moment around how to apportion someone's personal contributions to the business, in terms of culture and setting up processes and
Yep.
hungry for new business versus actually delivering the client work that we have in, and what's the split between that in terms of how should I recognize that
Yeah.
in terms of incentive structure for new business, like commissions essentially,
Yeah.
or end of year bonus where there's a portion that's about business performance if we've met our targets versus personal contributions to all of that. So yeah, it's a bit of I don't think there's
Yeah, you're 100% right. So you've raised a really good point where every type of business is every type of employee is different. So this is one for the accountants, right? This is the way I did it for accountants. However, managers is so different. So when I did, and it's funny, you can use ChatGPT to do this, right? So I went into ChatGPT and I said to them, give me, so I said, you're a director. Actually, I'm not going to type this down, but you're a director of a accounting firm, and you want to provide the roles and responsibilities to a manager who has X amount of years experience. I want to show to them the type of skills they need, the type of experience they need, how many people they need to manage, and also what are the key success metrics they need to be able to do well in their business or in the business. So what are the key success metrics they need to do well in their business? All right. And by doing that, I have now the kind of like the certain KPIs I have. And when I put that in, the key success metrics were managing a team of 5, or manage. It came up in ChatGPT, managing the team of 5 accountants, and it had like what else did it have? It had ensuring customer retention at X amount, and low client turnover. And then like there was another about feedback of customers. So these are things that then you can set into place. These are the indirect numbers that managers need to follow. Managing a team of 5 accountants, you can be more specific. Each accountant meeting expectations. So you know how I did the 3 times multiple? It doesn't have to be 3 times. It could be like 2.5. It could be like, double 2 times their salary. It's just up to what you decide. And then I also said to the managers as well to add on is learning being technical expert in tax topics or whatever it was. So there was a whole bunch of things that the key metrics says that manager needs to follow. And then, yes, you're right. There was something about like sales, like bringing in clients of X amount as well. So that's like what a manager would follow. So I said to the accountant, I was like, over time, I don't really care too much about this anymore, like your numbers. When you get to about 100K, you move from being an accountant to a supervisor to a manager. Like that's what you're transitioning to. These numbers don't mean anything to me because what I've been teaching you to do is like to do the work. But over time now, from 100K onwards, you're progressing to a manager. So you need to start picking up the new skills of managing a team, ensuring client retention, low client turnover. But with the experiences and learnings you had as a technical expert, you'll be able to. I can teach you these, or I can train you, or get the manager to guide you on how to do this. But these are the things that you need to learn next. And so therefore, these things here are things that I can pay you more for that you need to figure out. That's what I've been doing for managers. Sales and marketing, very simple. You just set like a goal of what your target is, and you split that up by months. So for example, I want $1 million in fees. All right, I want $1 million in fees, divide that by 12, divide that by average customers. I need 20 customers from you every month. Okay, that's just very simple to do, but that's kind of like how to do it in very simple terms. Per month, per customer. All right? It just depends on what type of employee that you're hiring.